And we'll officially get started. And I'll start the call, as I always do, with a very sincere thank you to everybody for joining us today. Today, we've got a great session. 3 guest speakers, 3 professors joining us to talk about the optimal equity allocation for retirement investors. And I'll introduce them briefly in a moment. I don't see Peter on the call, but I want to thank board member Peter Branner. He was the one who shared their work Beyond the Status Quo with me maybe almost a year or so ago. Read it with great interest, talked with the professors about a month or so ago. We had a conversation for about 50 minutes. And as I mentioned earlier, I think we'll have a similar discussion today, blocked out in 90. We'll see how long we go. So again, please ask questions, share your comments as we go along. If you don't have a comment or question, if you would, please mute your microphone to eliminate any background noise. And having said that, we'll go in alphabetical order. I'll start with Dr. Aizhan Anarkulova. She's assistant professor of finance at Emory University, earned her PhD in finance at the University of Arizona, as well as her undergrad degree in economics at U of A. Also joining us today, Dr. Scott Cederburg, associate professor at the University of Arizona, where he is the Thomas C. Moses Endowed Professor in Finance. He earned his PhD in finance at the University of Iowa and his MBA and BBA at the University of Nebraska-Lincoln. And also joining us today, Dr. Michael O'Doherty, professor of finance at the University of Missouri-Columbia. He earned his PhD in finance at the University of Iowa and a BS in chemical engineering and finance at Iowa State University. So Scott, Aizhan, Michael, thanks so much for joining us. At this point, I will turn the floor over to you. Feel free to walk us through your work, and then we'll just take any questions, share any comments as they pop up. So thanks very much for being here.
Sure thing. Let me share my screen quickly. All right, thanks, Bob. And as Bob just mentioned, certainly feel free to ask any questions that you have along the way. Just jump in, and we'll, we'd love for it to be a little bit of a discussion. So in this study, we're considering the life cycle asset allocation problem. So we're all saving during our working years, then we get to retirement, we're spending down from our savings, and there's this issue of what do we do in terms of asset allocation throughout the life cycle. And there's a couple of things that we all kind of know. Everybody should be diversifying across stocks and bonds, and generally, like, the young should hold more in stocks compared with the old. So we have this type of advice coming from all over the place. It's really ubiquitous in the financial advice that's given by financial advisors. It's in our finance textbooks and MBAs. It's in academic studies and popular books and all this sort of stuff. And I always kind of joke, if John Campbell and Dave Ramsey are telling you the same thing, they must be on to something. So, kind of importantly, in the US, it's also gotten its way into the regulation, where, as of 2006, with the Pension Protection Act, the Department of Labor subsequently set up these qualified default investment alternatives that effectively give employers kind of a safe harbor. As long as you make one of these your default in your employee, the employer sponsored retirement plan, then they're sort of free of liability on that. And these QDIAs are said to provide long-term appreciation and capital preservation through a mix of equity and fixed income exposures based on the participant's age. So kind of these age-based stock bond strategies have become very important. This has basically led to the rise of these target date funds. So this is a huge problem if we're thinking about it. Like, there's $600 billion in new money going into US retirement plans every year. So, there's massive amount of money. And right now, the target date funds are really kind of winning this space. So target date funds are QDIAs. I'll talk in a minute about kind of the specifics of target date funds, but according to Vanguard, they're the default in 98% of employer plans now, and people basically do whatever the default is. So 83% of retirement savers have at least some investments in a target date fund, and about 60% are fully invested in a single target date fund that matches their horizon. So this is kind of what people are doing at this point. And these really are age-based stock bond strategies. So this is the advertised glide path from a large investment advisor in the US that you would recognize. And so like kind of plotted along the x-axis is years since retirement. So if we're thinking about 65 as a base retirement year, when you're 25 years old at the beginning of this graph, they have you 90% in equity. It's kind of split about that portion split about 60-40 across domestic and international, and then about 10% in bonds. As you start getting close to maybe 50 or so, they're transitioning you out of equities and towards bonds, and then through, at retirement and through retirement, they're continuing to reduce your allocation to equity, increase your allocation to bonds and bills. And so by the time you're, roughly like 82, 83 years old, they basically have you about 83% fixed income and 17% left in equity. So in our paper, we're, as kind of the title suggests, we're challenging these two, stock bond diversification and the age-based strategies. And what we're finding in our study is that if we look at investing just 50% in domestic stocks and 50% in international stocks, hold that for your entire lifespan, it's going to outperform all of these different QDIAs that we can look at kind of all the major outcomes. So you're going to have more wealth at retirement. You'll have better retirement income. You have a lower chance of actually running out of money during retirement. So it's actually like a safer strategy to remain all equity during retirement, and then leaving a larger inheritance. So these are kind of all the major eventual outcomes. And if we kind of think about, you have your base of domestic stocks, everybody's going to hold something in domestic stocks. And then where do you diversify into? And the conventional wisdom has always been, get some money into bonds. The stock bond correlation seems fairly low. And so you can diversify and get some gains there. We really find that international stocks provide a much better diversification tool for domestic stocks compared with bonds. And so if you're looking at just a monthly horizon, or a monthly or an annual horizon, bonds, they earn lower returns than international stocks. International stocks on average earn about 7% versus 2.5% for bonds. But then international stocks are a lot more volatile, 23% versus 9%. So there's actually a similar Sharpe ratio, ratio of those two is actually pretty similar across those at kind of a monthly level. So there's a couple important things that happen as you increase your investment horizon. So I'm reporting variance ratios here. These are a way that we think about like mean reversion and stock returns. The primary evidence for mean reversion and stock returns has been these variance ratios. And what it's kind of telling you is what's the per period variance that you're getting from investing over a certain horizon. So with stocks, what we've seen is that the variance ratios shrink with horizon. And so with international stocks, for example, if you invest for 10 years, your variance on a per year basis is about 88% of what it is on a 1 year basis. And out to 30 years, it's down to like 76% of the variance on a per period basis that you get. So this is what we're talking about when like stocks get safer over time, they're better for kind of younger investors. And what's kind of interesting is if you look at bonds, there's the opposite thing happening. So bonds tend to have some continuation. If recent periods have been, we're thinking about everything in real terms. So like after inflation, and if you think about it, and if recent periods have been sort of like high inflation, increasing interest rates, which is both bad for bonds, then, if last year was high inflation, rising interest rates, then this year is likely to also be high inflation and rising interest rates. And so there's kind of a continuation with bond returns. And even at a 10-year horizon, they're already twice as risky on a per year basis as they are if you just have a 1-year horizon. So while stocks get safer over time, bonds actually get riskier for longer term investors. And then when we're thinking about kind of the classic textbook example of diversifying across stocks and bonds, we're typically using like monthly data. And so you have stocks and bonds, and they have pretty low correlations with each other. So, the old MBA example, mean variance, you get this nice little curve, and, you should hold some mix of these. So at a 1 month horizon, the correlation between stocks and bonds is only about 0.18. And international stocks and domestic stocks is like 0.3. But then when you look over longer horizons, and again, thinking in real terms, if you do have bad inflationary periods in your home country or bad long-term economic periods in your home country, we find that the correlations of markets within a country keep on rising with horizon, where that's not really true between domestic stocks and international stocks. So at a long horizon, bonds still only give you this relatively low expected return. They get riskier by themselves over time, and they get more correlated with stocks over time. And international stocks give you a high expected return. They get safer over the long run, and their correlation with domestic stocks doesn't really grow with horizon. So, and again, a big part of this story is inflation. If you have a really bad inflationary period at some point during your life, that's going to take out a lot of your value in nominal bonds. Whereas international stocks, we're also considering non-inflation or non-currency hedged international stocks. So you're just letting all the currencies float. And you get this kind of side benefit of international stocks where, I own a bunch of euro when I'm investing in Europe. And if the US does have an inflationary period, the dollar tends to depreciate relative to the euro, and I get to buy back cheap dollars when I bring my money back. So there's almost no correlation between the real returns on international stocks and inflation over long horizons. So this is kind of the intuition behind our main results on diversifying into international stocks rather than bonds. I'll describe what our setup is. So we're going to do a Monte Carlo simulation. We're going to simulate 1 million couples. Each of these couples, they're going to be eligible to work starting at age 25. They'll retire at age 65. And then they have mortality based on the Social Security Administration mortality tables. So just sort of random longevity based on a male and a female couple. Throughout the working years, we use this like a model that's from a recent paper that was fit to Social Security Administration worker data. And so there's kind of a familiar age-based where kind of you don't earn very much when you're young. You kind of have a peak, maybe mid 50s or so, and then income tends to drop a little bit after that. It has the potential for non-employment. We can look at different worker types in terms of high income, low income, early income, late income, all sorts of different worker types. Each of our couples as they go is going to save 10% of their income. We do build in full US Social Security according to the Social Security Administration formulas. So whatever earnings they have, we're going to have sort of the exact Social Security benefits that they would have had. During retirement, they're going to use the 4% rule to withdraw. So this is popular in the popular press. So if you have $1 million at retirement, 4% of that is $40,000. You spend $40,000 in the first year, and then every year thereafter, you just withdraw an inflation-adjusted $40,000. So this does introduce the possibility that you can run out of money in retirement if markets do poorly, or if you have, like exceedingly long life. You can run out of money with this particular rule, but our results aren't really sensitive to using different alternatives that people have looked at that kind of flexibly adjust that amount to. So then for each of these couples, we're going to consider a set of 8 different potential strategies that they're going to have for investing their money throughout their lifetimes. The first 5 are all QDIAs. that would qualify for this sort of safe harbor. So the first is the TDF that I showed earlier. So we're going to take the weights from that particular TDF. The next two are based on this kind of popular 60-40 rule of thumb, 60% domestic stocks and 40% bonds. And then we're going to do another version of that diversifies across domestic and international in the stock piece. And then we have a couple of age-based strategies. So there's been a 100 minus age strategy for a long time where you put 100 minus age into stocks. We find that 120 minus age does a lot better than 100 minus age, so we picked that one to carry around. So again, we have one that's fully domestic and then one that diversifies across domestic and international on the stock side. The last three that we're going to pick are not QDIAs, so these would kind of open up an employer to legal liability. The first one is just an investment that's 100% in bills, and we really included this one. This is kind of a proxy for supposing that you were invested in a money market or like a stable value fund. That's going to give you something close to this bill return. And this was prior to the Pension Protection Act of 2006. That was a very common default in a lot of employer plans. So in some ways, this gives us a look at like, what was the status quo, say in like the late 90s and early 2000s in terms of what people would have been defaulted into. And again, many people don't move themselves off of the default. And then finally, we're going to consider two all equity strategies. The first just being 100% in domestic stocks, and then the second one being diversified across domestic and international stocks. Okay. So relative to previous studies, we do two primary things that kind of set us apart on the methodology side. So the first one, it's very common to rely on the U.S. historical record when doing these studies, or when large investment institutions are sort of solving for their own life cycle strategies. U.S. data is very common. We tend to think if you're going to be saving for like a 75-year period, which is not totally uncommon for a couple, that the roughly 130 years of data that we have from the U.S. and sometimes the post-1960 period in the U.S. is also pretty common. That's only 60 years worth of historical data to learn from, and we're thinking about a 75-year investment horizon. So we think that that's a pretty serious small sample problem. There's also some authors that have suggested that the historical data, like the returns after the fact, are probably better than what investors had anticipated going in. So Eugene Fama and others have said that maybe expected returns going forward on stocks are going to be a little bit lower than they have been in the past. So what we do, we put together a data set that has it's developed countries, and we have 38 countries going from 1890 to 2019. And we really spent a lot of time like going back and figuring out what happened in a lot of historical periods and filling in a bunch of holes in the commonly available sources. So we end up with what we think is a pretty cool data set that has domestic stocks, international stocks, bonds, and bills. And we were very cognizant of avoiding kind of this survivor bias that you might tend to have if you're just looking at markets that are kind of currently successful. So this gives us a lot more information about what can potentially happen over long horizons for investors. The second thing that we do is a little bit more on the technical side. So there's a lot of like, say, academic studies that say stock returns are normally distributed and they just draw a return every month or every year from a normal distribution, and it's the same normal distribution every year. So like we would say in the academic literature that they're using these IID returns. This is identically and independently distributed. So basically every month is going to look exactly the same. Before you get the return draw, every month looks exactly the same. And we kind of know that that's not what markets look like. Like if we're in a very high volatility period, then we know that next month is also going to be highly volatile. Like volatility is very persistent over time. We also know that kind of on average, it doesn't always happen, but when stocks crash, there's some potential for them to bounce back relatively quickly, sort of the post-COVID thing. So if we did this IID assumption, it would like totally break apart all of these different time series dependencies that we have in returns. And we think that these are really important for thinking about long-term investing. So what we do, we use something called a block bootstrap approach. And so we're going to take our historical data set that has, kind of 30,000 months worth of data. And we're going to be drawing historical periods from that and kind of stringing those together to give us a sense of what could happen to us moving forward. But when we do that, we're going to be taking pretty long chunks of consecutive data from the same country period. So on average, we're taking 10 consecutive years of data. So again, this kind of IID approach would be like we would just take 1 month at a time. And what we're doing is taking about 10 years at a time and stringing those together. So we find in earlier work that there's massive differences between kind of what this IID assumption would give you. And there's really important long-term dependencies that we try and pick up and retain with our method. Okay, so I mentioned we're going to simulate 1 million households. We have these 8 different investment strategies. And what you can kind of think of is there's 8 parallel universes. Each of these couples is going to have the same longevity and the same income across each of these 8 things. And then in each of the 8 parallel universes, they just do a different investment strategy. And we're just going to follow them through and see what their eventual outcomes are. Okay, so just kind of getting into the results. We look at this first plot in panel A, all the way on the left. This is for the target date fund. This is summarizing the distribution of wealth at retirement. And the purple line in the middle is the median. We're going to do the 25th and the 75th percentiles to form the box. And then the 10th and the 90th percentiles are the whiskers. So kind of for reference, this couple saves, I think, about $250,000 total during retirement or during the retirement savings period. So with the TDF, kind of the median is about 600,000. So they've achieved some appreciation during the savings period, and then some chance that they get up to 1 million or 1.5 million, and so on. If you look at all the QDIAs, they have relatively similar distributions. Bills are sort of very bad, especially in real terms. You basically get no capital appreciation on average. And so it's just not a sustainable retirement savings plan. And then the 2 equity strategies, obviously with stocks having the high expected returns, you have better upside. So you see, possibilities of getting above $2 million. Domestic stocks also has just sort of a larger spread in outcomes. And if we would go down to like the first percentile of the distribution, like what's the 1% with the worst outcomes, how do they do? It's worse for domestic stocks than it is for any of these QDIAs. So the interesting thing is then if we move to the internationally diversified stock portfolio, it's better throughout the entire distribution effectively than these QDIAs. So the best outcomes are better because you have better upside with stocks. The worst outcomes are also better. Like the first percentile for the all equity strategy is better than the first percentile of the distribution for the TDF. So it kind of dominates throughout.
Hey, Scott.
Yep.
Can I interrupt with a question? Your database is really comprehensive, different than anything I've seen in the past. Can you talk a little bit about the domestic investor versus international exposure? Like if I'm an investor in the UK, are you taking 10-year blocks of like UK stock returns and mixing that with returns from Belgium or from Japan or from the United States? Can you get into a little more detail and where this is coming from?
Yeah, that's a great question. So the stance that we're taking in this line of work is just that developed countries are developed countries. And so if you're an investor in a developed country, then learning from developed country history is relevant. So if you're even if you're in the US, it's not just the US data that's relevant, it's data from other countries as well. And so then the domestic stocks, we're going to draw a particular period from, perhaps like 1980s Germany or something. And then the domestic stock is going to be whatever the German real returns were on domestic stocks. The international investment there is going to be a market value weighted investment in all other markets. So all foreign markets relative to the investor in Germany with the necessary currency conversions. And then the domestic bonds and bills would also be, in this case, like the German 1980s market. And then, yeah, as you mentioned, then we might pull, say, Japan as the next few years of data. So the underlying assumption that we have is that developed country returns are informative for developed country investors.
Yeah, thank you. And if I remember correctly, in the paper, you said something like the returns in the US were really good, but they're not like crazy good compared to other developed countries, correct?
Yeah, I think they're certainly not outliers. They're a little bit higher than the mean across all countries, but there are several of the countries that had higher returns and several that had lower, and the US doesn't appear to be a serious outlier on that.
Okay. Okay. Thank you.
Mhm. Okay, so a second outcome that we could think of is what's your, we're showing here a replacement rate, which is how much of your average working years income are you able to sustain in retirement? And this is considering both Social Security and your withdrawals from savings. So this, largely lines up with the wealth at retirement. If you have more money at retirement, you get to spend more money in during retirement. And then a couple of outcomes that happen like kind of during the retirement period. The one on the left here, we call it ruin probability. So this is, I mentioned that you can run out of money with the 4% rule. So if your investments don't do well, or if you live for a very long time, you can run out of money. We're plotting here, what's the probability of running out of money before the second of the couple dies? And so for the target date fund, it's about a 17% chance or so using the 4% rule that they would run out of money before death. Most of the QDIAs are relatively similar, balanced is maybe around 11% or so. Bills is really terrible. It's like 36% chance of running out of money if you're just trying to maintain an investment in bills. We do find that all the QDIAs have made an improvement in the capital preservation relative to being 100% domestic stocks. So that has a higher, again, domestic stocks, it has a high upside, but if stocks crash early and you're not diversified, that's a potential problem. This kind of surprising thing, again, like this diversified stock portfolio, not only does it have the high upside, but it's also getting you good downside protection. So it's around an 8% probability of ruin for this domestic or diversified stock portfolio. So that's like half of the chance of running out of money compared with investing in the TDF. So these QDIAs are trying to be safe by getting your money out of stocks and into bonds. But if you live for a very long time, you still have to be generating additional wealth during retirement. And if you do have an inflationary period during your retirement period, you lose a lot of that money in domestic bonds. They're just not going to come back. Like, so 2021, 2022 in the US, 10-year treasuries, you lost about 30% in real terms. And it's just tough to get that back, right? Whereas stocks, stocks can drop by 50%, but then they at least have the potential to come back. And then finally, like wealth at death, so a bequest is going to be the highest with the equity strategies, and the internationally diversified is the best on that too. So kind of across the board, it's going to dominate throughout all the potential outcomes. One way of kind of summarizing in a utility-based framework. So here we're going to calculate utility based on the consumption that we're getting for the household during retirement, and then a bequest. And we're just using a past paper to kind of parameterize this thing. But it gives us a sense of just kind of a one number comparison between two different strategies. And so our approach here was to think, okay, our base couple is saving 10% of their income throughout their lifetime. And so if we just go down to the bottom row here, suppose that you were saving 10% in the stocks, the internationally diversified stock strategy. How much would you need to save in any of the alternative strategies in order to get kind of the same amount of well-being, like the same utility from consumption and bequest? And with the target date fund, you would have to save 14.1% of your income. So in some sense, that's only like a 4.1% increase in the savings rate, but that's saving 40% more throughout your entire life. So, that we already have savings rates that aren't exceedingly high in the US, and we'd basically be telling people to save 40% more than they currently are to get the same level of utility. And kind of across the board, we find that same, the stock's eye is just significantly better than all the other strategies by these metrics. So one thing that we kind of gloss over up to this point is we were previously thinking about all of the eventual outcomes for investors, wealth at retirement, consumption, bequest, not running out of money. But this ignores the intermediate drawdowns. So we're defining here a drawdown. So imagine like your kind of account peak, and then just how did the assets do? Like, what's the biggest drop that you have in asset values from their peak? And if we look at the retirement period drawdown in particular, the all equity strategies do have larger drawdowns compared with the QDIAs, especially during retirement when the QDIAs have gotten you mostly into bonds. So the median drawdown for the internationally diversified stock strategy is a little over 50%. So at some point during your retirement period, your account drops by 50%. The TDF, it's only like 30, 35%. But all of those previous outcomes had these big drops in the middle. And then again, stocks can potentially bounce back and you still end up in a better spot, kind of on average, or almost all the time, you end up in a better spot by kind of riding out this storm. So we think that this is not something to just completely, sort of sweep under the rug, because there is I think the common fear that investors will display the fear when these periods happen. And so if investors are selling their stocks when stocks crash, then all of this kind of falls apart. And the QDIA regulations also say, QDIAs need to be diversified so as to minimize the risk of large losses. This is kind of the intermediate drawdown risk. So we think it's an important kind of policy issue, like how do we implement something that has better outcomes eventually, as long as people are going to stick with it, but put things in place that are going to help investors to actually stick with these sorts of things. So different countries set their rules up in different ways to give investors more or less flexibility along the way to adjust their thing. Some of the approaches that kind of lock investors into something may actually end up benefiting the investors, even though it feels like we're kind of taking something away, taking choice away from them. It may end up benefiting them in the long run. We can also think, just to get a little better sense of results, we can think about what happens in different scenarios. So this is comparing the chance of running out of money for the target date fund with the circles, and then the diversified stock strategy with the triangles. And inflation is a really big issue for long-term investors if we're thinking about supporting real consumption. If inflation ends up being really low, there's really no difference between target date funds and stocks. And you're probably not going to be running out of money if inflation ends up very low. It's really in these high inflationary periods where the TDF just gets killed. It's like 55% chance of running out of money. Stocks is, whatever, 19% chance of running out of money, which is still high, but it's kind of the best place to be if there is an inflationary period that pops up during your lifetime is in stocks. So that makes a big difference. Longevity makes a big difference.
Scott,
If
can I interrupt? Sorry, can you go back just one slide in terms of these quintiles? Do you know, can you ballpark it on an absolute basis? Like inflation in quintile one is what per year? Like 2%, and quintile five is 15% or something?
Yeah, I don't know the numbers off the top of my head, but basically like low inflation. There are long enough periods with close to zero inflation, like
Okay.
0 to 1 would be my guess, probably for low inflation. Quintile 3 is probably more like, say, 3%, 4%. And then like the high inflation, there have been extreme periods of high inflation
Yeah.
over time. Um, you know, Germany 1923 being the extreme example where,
Okay.
it was like trillion% inflation or something like that. But this would be like, but if you think about, even say there's like a 4-year stretch during your retirement period that looks like, say, the late 70s, early 80s,
Mhm.
where you have 15% inflation roughly for 3 or 4 years in a row, that really cuts into any nominal value that you have in bonds. And like the 1970s would have been a terrible decade. Like they were a terrible decade to own bonds. Interest rates shot way up, and there was a bunch of inflation. Um, and then kind of the subsequent decades were good as interest rates were continuously dropping and inflation was dropping too.
Yeah, I only ask that. I mean, given what's happened in the last couple of years, I think investors are more sensitive to inflation now than we have been for the last, 20, 25 years. So,
Yeah. Yeah. I think even relative to when we first started working on these projects, like people were more reluctant to think about, things like inflation shocks and stuff like that than they are now. Like it doesn't take very much to be like, oh yeah, that risk does still exist.
yeah,
And it doesn't take too much for it to just get a little bit out of control, even more out of control than it was for the past 2 or 3 years. I don't think it takes too much to push it up to 20% for 3 years in a row, and then there goes half of your nominal value in bonds.
yeah. Okay, thank you.
Okay, so the households that don't live very long don't tend to run out of money. It's the split between these really just increases. I mean, this is just showing like the longer that you live, the more you need to actually like make additional money, like generate additional wealth during the retirement period. So then the stock strategy is better for that. And then an interesting one is the worst case scenario is your all equity and stocks crash during your retirement period, right? So this is looking at the realized, you don't know what's going to happen before the fact, but the realized domestic stock returns that you get during retirement. And you would think, oh, if you're way on the equity side, oh, sorry, if you're way on the equity side and stocks do really poorly, you're going to be in trouble. And your probability of ruin is like 25% in that case, but the TDF is still actually worse. TDF is like 34% in that scenario. And the TDF still has you some in stocks, but the other part of this is if stocks do poorly, if domestic stocks do poorly over a long period of time, domestic bonds also do poorly over that same period of time. We have previous work that I think if domestic stocks lose over a 30-year period, then the probability that bonds are also going to lose over that period is like 65%. They're probably also going to lose relative to inflation. And so there's, we're not really saying, I think we like to emphasize, we're not saying that being 100% invested in stocks is totally safe. Like these are still probably higher probabilities of running out of money than you would like, but you have to invest somewhere, and we're finding that it's the safest alternative. And these things that are traditionally viewed as safe, like a target date fund, actually aren't that safe once you think in the real terms, and once you're getting all these kind of long-term properties of returns taken into account. So the last thing that we do is just to sort of reconcile with previous studies and with what the conventional wisdom is. We can change these couple of things. We said we went away from the US sample and went to the developed country sample, and we went away from this kind of IID assumption, and we were pulling consecutive chunks of data from history. And what we find, basically, like this is our base result. So the stocks strategy has a much lower probability of running out of money compared with like an age-based stock bond strategy. And as we relax either of these assumptions, it kind of closes the gap between these two things. But it's really when we think about using only US data and using this kind of IID assumption that the result flips and it actually becomes safer to be in bonds. So we think I can see different viewpoints on the US sample versus the developed country sample. We kind of think that you should try and learn from a broad base of history, but you can, like, there's always this argument that comes up like the US is special, and so we should think about the US sort of differently. Here's thinking about the US, but using our kind of block bootstrap approach that maintains time series properties. The thing that the assumption that's really tough to justify, we think, is this kind of IID assumption that this month is totally disconnected from last month. And so we think that at a minimum, you should be thinking about, maintaining these time series properties of returns. And this is really, if you look at a lot of the academic literature, they're using normal distributions based on, US returns, or, some of the large institutions that are estimating stuff based on some recent US data. It does kind of look like this type of an approach, which is kind of the only thing that gets you this result. We think that sort of these other ones are a little bit more reasonable in our viewpoint. So yeah, just to kind of wrap up, we're challenging these things. This is really kind of an empirical paper where it's just like, given the constraints that you have as an investor, looking at the data, what should you be doing? And we're just finding this sort of extreme solution where you should just be 100% in equities, importantly, diversified across domestic and international markets. But then that thing outperforms all of these QDIAs in basically all of the important retirement outcomes. So we think it's a really important problem, and that we should think carefully about getting better solutions for everybody.
Okay. Scott, Michael, Aizhan, thank you. Thank you so much. I got a couple questions that I'd love to ask. I'll put those on hold for a second and turn it over to our board members. Any questions or comments on what was shared today?
Barry Gilman, can I jump in with a first question or comment? Because Bob and I have done a lot of work over the years on related problems on this at the Institute and now at the Brander Center. So it's like a couple of observations. I think excellent research. First of all, in defense of target date bonds, which I'm not usually on that side, they did do, or they have done, I think what they were originally intended to do, which was to take people out of cash or cash type investments as their default and get them into some stocks. It may not be enough stocks, but it got them into some stocks. And it also got apathy and ignorance on the right side of the divide, in that people, once they put the money into target date funds, had actually kind of left it there. Because the biggest issue, as you point out in your paper, is the psychological issue, I think, of people panicking at the wrong time. And it's not even the pain of the psychological issue, it's the action. People, if you have to suffer pain, they suffer pain. But when people bail out at the bottom, which they do, because otherwise there wouldn't be these peaks and crashes in the market, that's what really wrecks this model. So my suggestion would be, if to give advice to people that they should just be at 100% stocks throughout, is maybe good advice, but I don't think it's practical because people will blow it up. If the advice were to be to go to find TBFs that have much higher equity components and just leave your money there, I think that might be more workable. I'd be interested in your comments on that. And one other comment, then I'll shut up. One of the things that we've observed is that most studies that look at pre-retirement and post-retirement, I'm not sure those are the right periods to look at, because in practice, what we found with a lot of our simulations is the biggest reward or damage that is caused to retirement portfolios is typically between the ages of 55 and 75. Because for most people, that's when they have the most assets, right? It's the end of their accumulation period and the beginning of their decumulation period. So the actual assets they have are quite large compared with almost any other time in their lifetime, certainly in the early years of saving. And so the chance of a hit of a bad market or a really good market is much amplified in absolute terms over that period. So one of the things that I'd like to see, just generally, I'm throwing that as a comment, is more focused on that time period, at age 55 to, let's say, 75, as a distinct time period in the lifespan planning. So I think the plan there should be somewhat different than before and after. Anyway, just a few comments and some built-in questions in that.
Yeah. Aizhan, Mike, do you want to jump in?
Yeah, I think the first comment about like the fact that the regulation is set up the way it is, we actually talk to people, and that is true. We view this, our paper, at least I personally view it, if we could shift the priors of people towards stocks more, be like, they're not safe. None of our evidence, including the prior papers, ever say that stocks are safe. In fact, our published paper in 2022 says stocks in the long run are actually very risky. You just need to know how risky they are. It's just like you can't keep it in bills either. You can't just keep it in cash because inflation is one of the high risks that may not be directly observable. Like it just erodes the value of your portfolio over time, little by little. And so our suggestion, when we look at like what if currently we're working on the paper and we're just looking at what other combinations, like if you were to just look at different percentages of bonds versus stocks, is there like any ratio that you would have preferred? And we find there is like a monotonic relationship. More bonds is worse. Like you still want, but at certain level, if the alternative is that you're going to pull out of the market at the worst times when it tanks, yes, you should take the comfortable level. Like if it's 20/80, go for it. But if you can, like if you personally can go with like 10/90, that would be better. We just want to raise the awareness like that you have to hold equity. But when people make personal decisions, I think they have to like decide for themselves what's the best mix there.
Yeah, I think it's kind of interesting to look across countries too. So like the Netherlands, there's a big pension system in the Netherlands, but people basically, you buy into the pension and then the pension invests your money and then you get payouts during retirement, and in the intermediate time you just don't have the asset allocation flexibility. And I think Sweden has a similar thing, and I need to look this up, but people were telling me, I went to a pension conference in the Netherlands, and apparently Sweden, I think, is like they're levered even, like they're investing people's money, like pretty aggressive strategy, even with leverage and everything like that. It's just that the end investors don't have the choice of pulling their money out early. So I think I think we should think about some of these possibilities as ways of getting around this problem where people are going to panic and sell at the wrong time.
Yeah, just to wrap, I agree. And in fact, the Netherlands is, as far as I know, is looking at this right now, and I think has mandated a collective defined contribution as the default, which basically does exactly what you said. It takes the decision making away from the individual and puts it with a professional management. I think that makes a lot of sense. And TBFs do somewhat the same thing, other than the fact you've got to elect to go into it in the first place. Of course, as an individual, you can always come out of it. But yes, I mean, that's why I said earlier that it sounds a little crass, but apathy and ignorance have long been the bugbear of the industry. If you can actually flip it so that apathy and ignorance cause people to make the right decisions or not make the wrong decisions, then you're better off.
Yeah.
Yeah, I think that's been a lot of the focus in the last 20 years or so with the Pension Protection Act and subsequent, research and everything. Like it's just making the defaults now. I mean, I think a lot of jobs now, when you start, it starts taking out 3% retirement contributions, and then that gets bumped up by 1% per year, which is the default, and everybody will do it as long as that's the default. So I think we agree that having the default be something good is reasonable. I think like my kind of ideal outcome on this line of research would be that some of the big financial institutions and like the pension consultants and everything like that's where all the decisions move.
Mm-hmm.
But we should be thinking very carefully about how to model these long-term returns. And it sort of sounds like we've had lots of retirement research and thinking about all sorts of different aspects of the problem. But I think we feel pretty strongly like the most important aspect of the retirement savings problem is the returns that you're going to get on the asset classes that you're invested in.
Mm-hmm.
And I think trying to push forward a conversation on what's the best way to model those returns, I think would be my ideal outcome.
Thank you.
So could I just throw a couple of thoughts in? So I was the head of product development for Columbia Threadneedle Investments, which was Bank of America's, when it was Bank of America's global asset management business. And I've created target date maturity funds as well as age-based programs for the 529 programs, as well as the retirement programs. Just a few observations. Think of it from a college saving perspective. You have a finite period of time. You're getting close to the college date. You cannot stay 100% in equities, because when it's time to pay the bills, if you have a 50% drawdown, you're going to be in big trouble. And 50% drawdowns happen more regularly than people realize, right? So it happened in 2008. It happened in 2001, just on the Dow Jones Industrial Average. On the NASDAQ in 2001, it was down 78%. And those types of drawdowns are almost impossible to recover from, especially when you're thinking about things on a goal-based investment strategy from that perspective. Over long periods of time, if you look back, equities is obviously the best place to be, 100%. 100% S&P 500 fund would have been, over the long run, the best place. When you look at all of the studies, it specifically shows that while equities are risky in the short term, over long periods of time, they become the more riskless asset. So just throwing it into thinking about it that way. If you're 55 or if you're 70 and you're 100% in equities and you have a 50% plus drawdown, I mean, I hate to say it, go back to 1929, people jump off buildings because of that, just because they don't have the time. Another thing to throw in, wealth is not distributed the way people generically think about it being distributed in the United States. We're 5% of the world's population. We're 25% of the world's GDP. But 50% of Americans have zero saved for retirement. 80% of Americans have less than $100,000 saved for retirement. 93% of Americans have less than $499,000 saved for retirement. If you have $5 million, you're in the top 0.1%, not 1%, 0.1%. So the vast majority of wealth is actually not distributed across the population. It's in the hands of the wealthy few. That's just, that Professor Stiglitz, who won the Nobel Prize at Columbia, made that. I think the 3 top tech entrepreneurs control the equivalent net worth of the bottom 35% of all Americans combined or something. It's crazy. But again, that just gets into a lot of people don't have money, have the money that people think. So if you have $100,000, you're 80% of America, you have a 50% drawdown, you're down to $50,000. You're not going to make it through retirement, period, right? You take into consideration like long-term care. Average long-term care could be over $100,000 per spouse. I mean, the whole thing is just gone. So I 100% agree that all equity is great, but I go back to modern portfolio theory, goals-based investing. The more time you have, the more that strategy makes perfect sense. As you get older, you don't have the time to recover from a massive drawdown. So an all equity portfolio just doesn't seem to be the prudent way to go. The other thing I would ask is, the assumption that markets bounce back has historically been true to some extent, but it's not universally true. So if you did your study, but let's say instead of the US population, you did it on the Japanese population, and you started doing your studies in 1986, and then 89, you had a massive drawdown and no recovery for 30 some odd years. I don't know that, people would generally be willing to say this is a wise strategy. I think you could do the same in the US markets if you started in 1926 and went through, 1929, where it took a prolonged period of time until the early 50s for people to recover the drawdown on the equity portion of their portfolios. If you were 60 or 70, you would have never recovered. I mean, you would have just had a massive drawdown, of which then you would have had a spend problem because you would have spent through any assets that were remaining. Over 50% of your assets would have been gone. So I'm just throwing out some ideas the way I tend to think. I think you kind of got to think, in my perspective, age-based investing. You've got to think, time periods to target. You've got to think through different generational cycles. I think we're in our cycle today. Our mindset today is markets bounce back always. I don't think that's totally true. I think, if you were to look at the Great Depression, the people that lived through the Great Depression, their mindsets would not be the same as our mindsets are today, because they just didn't experience a world where markets bounce back. Whereas, for the last 50, 60, 70 years, markets have always bounced back. Japan would be, I think, more presently in that mindset of the Great Depression era versus our era in the United States. So let me be quiet. I'm just throwing out just some casual observations that I think of when these types of things.
Yeah, definitely appreciate your perspective. I think it's important to note that our data does include all of those periods in terms of the U.S. Depression, in terms of Japan. One thing about Japan, so over that kind of 30-year period starting in 1990, their real domestic stock return was minus 20% over that full 30-year period. But an international investment for them, you would have gotten 400% on your international portfolio. So that's one of the big keys that we're saying is like you got to be diversified internationally in order to do this. And then going back to your first point, I'm definitely sympathetic to this kind of like set time period of like a college savings. Like you're talking to somebody. I graduated from high school in 2000, and my $20,000 of mutual fund investments that I had built up by working as a kid, I withdrew $8,000 and it was all gone. So I was definitely a person that got hit by that. I think I don't know that I would want to generalize our study to somebody with an exact set time frame for something like an exact ending date. But one thing that we've been working through recently, we're studying like would somebody who is 100 years old, so, still have an uncertain lifespan, but there's, it becomes relatively shorter at that time, would they prefer to start investing in bonds? And if we're just asking the data and we're not putting our thumb on the scale, if we're just asking the data, they still don't prefer to be putting anything in bonds at that point.
Yeah, I want to just like maybe emphasize a little bit more that uncertain mortality, like the fact that you don't know how long you're gonna live, makes a big difference for our study. Like this is one of the key innovations in our paper is we are able to like model our life cycle, like the couple, as close to reality as possible. So we're trying to look at like uncertain income, like the stochastic income. We want to see about if you knew. So again, like thinking about like I think the college tuition example is you know exactly you need this much amount of money when you have to pay, right? If it was the case that when people retire, say at 65, they needed all their money, like they want to consume all of it, that would be a different question. The thing is, when you are retiring, it's like an important milestone in your life, but you're not gonna consume all of the savings. You need it to last long. And so here, like I was actually recently talking to like in Atlanta here, and a CEO of the financial advising company who talks to like retirees. Again, this is probably not an average retiree because even $1 million in retirement at the time when you retire is a lot for Americans. But the thing is, the way those investors think is, I want to spend, say, 4,000, like just want to withdraw 4,000 from my savings on top of my Social Security. And then at the same time, they want bequest and they want their money to last. But the thing is, what they don't realize too is when it's 20 years down the road, they will realize that the fixed amount that they are withdrawing in nominal terms is not enough anymore to support the same lifestyle because of the inflation. So, like, I just want to say that it's like the fact that you don't know how long your investment period is very important and it's kicking in our results. And that's why you need stocks, because as you start withdrawing little chunks of this wealth, the rest of your money is at least still going to grow at higher rates than, say, in bonds.
Yeah.
Yes.
Hey, Aizhan, Jay, thank you. Scott, thank you. Want to make sure, I know Zev, you have a question. Peter Branner, who introduced us to this work, has a question too. Let's switch to Zev, and then if we have time, I can share some more comments later. Zev.
Yeah, thanks, Bob. I just want to make sure that I understand how this works for a non-US investor. So in my specific case, I may be the only Canadian here among the attendees. Obviously, we have a very small market that currently accounts on a capitalization basis, maybe for around 3% plus minus of our world. So if you simulate your work for Canada, you would take, and correct me if I'm wrong here, you would take 50% of the equity portfolio and put in Canadian stocks, and then the rest in a market value basis of all the rest of the developed world, obviously adjusted to currency movements. Is that correct, that this is the kind of work you do?
Oh, you're muted.
Scott, you're muted.
Yeah, thanks for the question. That's so to some extent, the reason that we do 50-50 in the paper is it's a simple rule of thumb, and it's less of a deviation from a US market weight. What we actually find if we like fully optimize is 33% domestic, 67% international. So that does slide it down a little bit. And then there's not actually huge differences, say between like say 2080 and 3367. So I think if you're in, so I think like a Canadian investor, say, 25%, I'd be perfectly happy with 30%, anywhere in that neighborhood. I think you do want to avoid sort of the 3%, 97%
Sure. Yeah.
allocation, because like currency movements in the Canadian dollar versus if the Canadian dollar strengthens over a long period of time, that's going to kind of kill your international investments. But to some extent, we present the paper a little bit differently when we're presenting it here versus in Europe versus talking to people in Canada, just on what that, where that actual sliding scale would be.
Well, the reason I asked, and the reason I asked, I'm sure you know, I mean, if you tell today to most, people in the industry, in the investment industry, or even academics here, put half of your stock portfolio or even a third into Canadian stocks, they say, are you crazy? I mean, for such a small market, you call this a diversified portfolio? I mean, the Canadian market is essentially, we have a little bit now in IT and, maybe knowledge industry, but basically, historically, it's been banks and resources. So how is that, that runs against the intuition of you've got to be diversified. And that's why I asked, it's a very biased market, if you like. And
Yeah, so like our results, when we completely do the optimization of like the 50-50 heuristic is just something that will stick in people's mind easier than like a whatever other numbers, right? But when we do the actual optimization, we find it's something like 33.67%. Then again, just like want to point out that suggests for a US investor, the market cap in the world is like 50-50 roughly.
Yeah.
That would be in line with the market weights. We suggest for a US investor, it should be a little bit lower, right? Market weight. Now, if you take the perspective of a Canadian investor, it's a high, like it's actually high home bias is what we are proposing here, like be more invested. Now, the other thing I want to also mention is our current model is calibrated to US Social Security, US longevity. If you were to like, you would have to think a little bit more because we don't do that. What it would be like if you're an European investor, your life expectancies are actually higher, but you may have better social security and that kind of thing. We do focus on a US couple.
Will it also depend, incidentally, now that you mentioned, Social Security and all that, let's say you have a generous defined benefit plan, which, in Canada is fairly universal for public sector employees and, including university professors and so on. That will change, I think, the math here because, in particular, if it's indexed to inflation and you know what income will be for the rest of your life, to the last day in real terms, you can take more risks in the rest of your investments. Definitely, if you want to leave an inheritance. Yeah.
And you should still go for stocks, right? That's
no,
the
I
same
agree.
portfolio
Sure.
we find because our outcome is kind of like, even if you are getting from defined benefits and would you not take more money from your like the investment that you have here? Like you probably will be willing to take even more risk in that case.
Yeah, for sure. Okay, thank you. Yeah.
Good stuff, Aizhan. Thank you. Peter, you still with us? Got a question? Peter. And now I can't hear you. If you can maybe put your question in the chat, I can share it with the academics, or if you come back, just feel free to jump into the conversation. There's a number of things that I could jump in on. And one of Jay's points, the whole notion of like investing in Japan in the late 80s, how did that work out? I think that's one reason why you're suggesting an international diversification. So you can get around some of that to a certain degree. And I hear, oh, Peter's typing, mic does not work. Okay, Peter, yeah, just type it up in the chat and I'll relay. But also I hear Aizhan saying, just increase exposure to equities. And one thing I was thinking of, if there was more awareness of this work, maybe if I'm in a plan and I'm in my 20s, I don't invest in the 2050 target date fund or the 2060, I invest in the 2080 or the 2090. I'm going to purposely increase my exposure to equities to give myself a better chance of hitting my goals. And then the other thing I think of, to Barry's points about the importance of investing in that 55 to 75 range, that might be an area, if you haven't done it already, to kind of break out that and say, okay, this is where you can make and or break your retirement planning more so than if you're 25 or 85, let's say.
Yeah, we can definitely break that out. I think that makes a lot of sense. Like the only thing that we've done that's like the kind of conditional results that I showed was the entire retirement period. We did also look at this like extreme stock market crashes that happened in the first year after retirement. So like during that sort of 65 to 66 range, and you were still better off being in stocks as long as you're sticking with it. But again, the key is always get people to stick with it. So
yes, and our focus on behavioral stuff, we constantly grapple with that. And a couple of things that I think of, I'm going to put that on hold because Peter is asking, the difference in allocation is linked to loss aversion. I wonder if they have reversed engineered the price of the insurance that people apparently are willing to pay. It's a bit like taking out an insurance on a house and then being sad that it never burned down.
yeah, I don't think we've quantified anything in that way, but we can definitely.
Yeah, we do look at different levels of risk aversion. So like the in our utility model, we can try like in academia, you can have that parameter for the risk aversion vary from 1 to 10. 10 is actually pretty high, and that's not like changing the results, but I think the other thing is we didn't mention it. If you could have, so kind of like thinking of insurance, if there was a product, and I know there is, but it's just not a big market that would guarantee you something in real terms, like tips. Would you take it? And again, there's no data for us for tips because it's a relatively new product, even in US, and it's not even available in all the markets. Like Canada completely stopped, and that's because from the issuer perspective, it's an extremely risky thing. Like the insurance that you're talking about, I think the price has to be high. If you're selling it and you're trying to insure against all of this risk, it would have to be a high price. So with tips, we have done, it's not, I don't think it's currently in our paper, but we've looked at what if you had hypothetically. So we did like a hypothetical tips. Somebody is going to offer you this inflation protected bond that will pay you either 1% or 2%. So those the yields in real terms. What would be your allocation? Yes. So investors would like moderate amounts of like up to maybe 30 to 40% in retirement of some of this. However, you will have to face a trade-off. So if you worry all about your consumption in retirement, you will want a little bit of that tips in your portfolio allocation when you're retired because it's guaranteeing you some real withdrawals. But you will end up with a lower bequest. So it's not even like best in all terms. There is a trade-off. What is your preference? And again, like I said, it may not even be available in the market.
Yeah, I think one of the really tough things with thinking about tips is, I mean, I want to say it's down to like 4 countries now that issue tips, and it's been over a relatively short period of time. And what we really haven't seen yet is, I mean, we did see, I guess, in the mid 2010s, tips yields that were maybe like minus 1.5% or something. If we look historically, there have been periods with pretty high sustained inflation where the bond yields were not close to making up for the inflation. I wonder, I mean, the only way that I can think about an equilibrium with tips in there is to have, there's some periods I think when tips are going to be minus 5% yields. And so I think we can view tips as these really safe things, but if we have any reinvestment risk with tips, they're actually, I don't see a reason why those would continue to give 0% real yields when nominal bonds are earning minus 5%. So the products and those would be the types of things I think to Aizhan's point of these types of insurance products would have to be kind of expensive. It's like, how does an insurer support real payouts on one of these types of products with the possibility that even something like tips are just going to kind of fall apart for them.
Yeah, and yeah, it's a great point, Scott. And as Aizhan was speaking, Peter texted me again and said, it's an embedded option and very expensive. So the other thing that I think of, and Aizhan kind of touched on this when you mentioned talking with an advisor, like how important would advice be in these situations? Because in my brain, you've got all these options now with automated robo-advisor type things. But what we're talking about here kind of leads me to believe, okay, we're dealing with things like loss aversion, we're dealing with asset allocation, we're dealing with time horizon, we're dealing with asset levels, bequests, all of these things. How important is it to talk with somebody to get kind of a customized solution for you?
Yeah, I think that I mean, I feel like a lot of the financial advisors view that as a big part of their job, is to just sort of be the person that talks people off the ledge in these types of circumstances. And yeah, I think there needs to be more thinking around. I mean, it's a small thing, but I know when I log on to my Fidelity account, like my retirement account, if the market has been going up, it'll show me these short-term graphs where my account balance is doing this. And if the market's recently been going down, it shows me some long-term graph where I've still made progress over this time. There's just a dip at the end. But I think some of these like psychological pushes are I don't criticize them at all for doing that. I think it probably makes sense to try and get people to be focused on the right things.
Yeah.
I think what's more important is like financial literacy. Because maybe, and I personally view that sometimes financial advisors are probably just like providing financial literacy. Like there was once a seminar on Robinhood, which is a platform where you can invest in stocks, and like the top number one question is, what is stock? Like people don't even know what that is. So if that's what you pay for, maybe like that's fine. This is what.
So could I just reframe this two different ways? One, you're 63 years old, each of you. Would you put 100% of your money, if you have $100,000, you're part of the 80%, would you put 100% of your money in equities? That's question one. Question two, you're a financial advisor and you have clients that are 65 years old. Would you put 100% of their assets in equities the way you're proposing? As the advisor, you're responsible, and you could get sued out of existence if somebody feels as though you did not invest like a prudent investor would have invested, meaning using MPT and modern, assets. So I'll stop there.
Yeah,
Jay, if I may add my experience there as a private banker and advisor there, we usually separate two things there, which is money for the next generation and money for your life cycle. So that's the key. And being private bankers, then definitely we are in a privileged position, because usually these kind of households, they are overfunded. So then out of a sudden, there are these two different problems: the life cycle problem, which is basically an asset liability management problem. And I think most of the hypothesis that this brilliant paper you were showing is answering this idea. But then if I may add a different perspective, the thing is that usually our clients at private banks, they let's say they die richer than they were before at the 65 years old, which is nice, but indeed it makes a huge contrast with this idea of investing everything in bonds at 65 years old. Let's go for an extreme. So I would definitely say, and if I may add this point to this idea of, let's say, behavioral finance versus Markovich framework finance, that our customers at 70 years old, they have a new objective in the, let's say, life cycle moment, 65, 70, 75, which is money for the next generation. And then definitely this adds a new set of variables in the problem, because then the investment horizon is so long that equities are allowed, even private equity or private debt is allowed with this 20, 30 years perspective. But it is a completely different problem, I guess.
Yeah.
That's my point but we're talking that group of investors, you're talking 5 to 10% of the population. It's not the 90%. The 90% just doesn't, they don't have.
This 95%, they need your life cycle funds, definitely.
Yeah. Yeah, I think it's a great point. Like both of these great points. Yeah, I definitely agree for the very, very long horizon thing. It makes the problem even simpler. There's definitely this contrast between like what I'm going to do and what I could tell somebody else to do within the legal framework. That's why we have, you know, like, I think at some point it's our ultimate goal would be push equity allocations a little bit higher among that entire group of TDF and the pension consultants. If everybody raises everything by 5%, then everybody has cover for it. You can't be the one TDF that goes out and does 100% equity. That's just not the way the world works. So, and so I think it kind of has to be some coordinated change across, you know, pension consultants and investment investment advisors. So
I appreciate that perspective.
Great comments, great questions. We got about 5 minutes. Anything that we haven't touched on, Michael, Aizhan, Scott, that you want to mention?
Yeah, I think like Jay's point, maybe about like if you look at certain historical period, you're gonna observe like whatever, like people look at what if you were to pick between 1950 to like 1980 or between 60 to like 1990s. What we are looking at is like a distribution. We're saying probabilistically what can happen. Again, we don't know what the next 30 or 50 years are going to look like. We don't know where in the distribution it's going to fall. So we can't be like the fortune tellers who are telling, oh, this is how, like this is exactly what the stock return is going to be, or this is what the correlation. We're just telling what the historical data in the past looks like. Now, is the future going to be like the past? Most probably, because what other alternative do we have? But then again, which part of that past, we don't know. We're just telling something as long the dimensions of like, this is like statistics.
Yeah, I mean, we could have a great conversation for hours on the difference between uncertainty and risk, right?
Yeah.
All right, I think we'll wind up there. Just terrific job. Scott, Michael, Aizhan, really valuable information, great questions and comments from our board. So thank you to all of you. And looking ahead, next meeting, September 4th, 8 a.m. Pacific with my colleague, Joey Engelberg. Scott, Aizhan, Michael, if you want to join us, feel free. He's going to talk about politics without getting political. We'll see if we can walk that high wire. But basically, I shared, or I will share, some of his research that looks at partisanship in the U.S. and political partisanship and its effect on decision-making in realms outside of politics. So this should be a fun conversation, especially as we get closer to the election here in the States. So once again, thank you to our guests, Scott, Aizhan, and Michael. Thank you to each of you, our board members. I'll send around the invitation for our next meeting, and hopefully we see you in September. Thanks again, everybody.